Welcome to the table where the green meets the gold.
Welcome back to the $50 Dividend Investor Podcast, the show that proves you do not need to be wealthy to start building wealth. I am your host, K.R. Talon, author of the $50 Dividend Investor, available on Amazon. Each episode, we take one powerful concept from the world of dividend investing and break it down in plain, everyday language. No jargon, no fluff, just a clear and honest roadmap for the everyday investor. Let's get into it. What if every dividend you earned automatically bought you more stock, without you logging in, without you making a single decision, and without you lifting a finger? What if the money your portfolio generated just quietly went back to work for you, around the clock, every single quarter, compounding on itself while you slept, while you worked, while you lived your life? That is not a fantasy. That is a real, accessible tool that has been available to everyday investors for decades, and most beginners have never heard of it. It is called a DRIP, a Dividend Reinvestment Plan. And by the end of this episode, you are going to understand exactly how it works, why it is one of the most powerful strategies in the $50 Dividend Investor, and how to set one up even if you are starting with your very first $50. Let's start with the basics, because the name tells you almost everything you need to know. A dividend reinvestment plan is exactly what it sounds like. Instead of receiving your dividend payment as cash, which most new investors would either spend or let sit in a savings account doing nothing, a DRIP automatically takes that payment and uses it to purchase more shares of the same stock. You don't see the cash. You don't move the cash. The system handles it entirely on your behalf. And those new shares you just bought, they earn dividends too, which then buy more shares, which earn more dividends, which buy even more shares, and on it goes, quietly building in the background of your financial life. This is the engine that powers long-term dividend wealth, and it costs you nothing extra to run it. Now, here is something most people don't know. DRIP plans are not a new invention. They have been around since the 1960s. Back then, companies began offering them directly to shareholders as a way to reward loyalty and keep long-term investors engaged. The idea was simple. If you believe in this company enough to own it, we will make it easy for you to own more of it automatically. No broker, no commission, no middleman, just a direct relationship between the investor and the company. Those original plans were called Direct Stock Purchase Plans, or DSPPs, and many of the largest, most stable companies in America still offer them today. I cover specific examples of companies with strong DSPP programs in the $50 Dividend Investor. Because for a beginner with $50 and no brokerage account, a DSPP can be the single most accessible on-ramp into the market that exists. You go directly to the company, enroll in their plan, set up an automatic monthly contribution, and the shares and dividends are managed entirely within that plan. No app required, no trading platform to learn. Just you, the company, and a recurring $50 commitment. Of course, today, most investors access DRIPs through a brokerage account, and that is perfectly fine too. Nearly every major brokerage and many of the newer investing apps allow you to turn on automatic dividend reinvestment with a single toggle in your account settings. Once it's on, every dividend payment you receive is automatically converted into fractional shares of that same stock. And that word fractional is important. It means you do not need a full share's worth of dividend income to reinvest. If your dividend payment is $4.12 and a share of that stock costs $80, you still reinvest. You simply receive a fraction of a share, roughly 5% of one share, and it counts the same as a whole share for future dividend purposes. Fractional shares completely removed the barrier that used to exist for small investors, and they make DRIP investing viable from day one, regardless of how small your starting position is. Now I want to talk about the compounding snowball, because this is the visual that I think makes dividend investing click for most people. Imagine a small snowball sitting at the top of a long hill. When you first push it, it moves slowly. It picks up a little snow as it rolls. Not much, because it is small and the early momentum is modest. But as it keeps rolling, it gets bigger. And as it gets bigger, it picks up more snow per rotation. And as it picks up more snow, it grows faster.
And by the time that snowball reaches the bottom of the hill, it is enormous, far larger than anything you could have built by hand by stacking snow yourself. That snowball is your DRIP portfolio. Your initial $50 investment is the push at the top of the hill. Each dividend reinvested is a layer of snow, and time is the length of the hill. The longer the hill, meaning the longer you stay invested, the bigger and more unstoppable the snowball becomes. Let me put real numbers to this so it is not just a metaphor. If you invest $50 a month into a dividend stock with a 5% annual yield and you reinvest every single dividend, here is what your portfolio looks like over time. After 10 years, you have contributed $6,000 of your own money, but your account is worth approximately $10,000 because your reinvested dividends have been compounding on top of your contributions the entire time. After 20 years, your out-of-pocket contributions total $12,000, but your account, thanks to DRIP compounding, has grown to somewhere between $30,000 and $35,000, depending on dividend growth. After 30 years, and I want you to really let this land, you have contributed $18,000 of your own money, $50 at a time, and your account could be worth over $70,000. That gap between what you put in and what you have is not luck. It is not a market prediction. It is the mechanical, mathematical result of reinvesting dividends consistently over a long period of time. The DRIP did that. You just had to start and stay. Now let's talk about how to actually set one up, because information without action is just entertainment. If you want to use a direct stock purchase plan, the best place to start is a service called ComputerShare, which acts as a transfer agent for hundreds of major companies and administers their DRIP and DSPP programs. You go to their website, search for the company you want to invest in, and enroll directly. Many plans have no enrollment fee and allow automatic monthly investments as low as $25 to $50. If you prefer to use a brokerage, simply open your account settings after purchasing shares, find the dividend reinvestment option, and turn it on. It typically takes less than 60 seconds. Either path works. The best one is whichever one you will actually use and stick with. There is one thing I do want you to be aware of before you set up your DRIP, and it comes up in the book as well. Reinvested dividends are still taxable in the year they are received, even though you never touched the cash. The IRS treats a reinvested dividend the same as a cash dividend for tax reporting purposes. So if your dividends are reinvested automatically, you will still receive a 1099.div tax form at the end of the year showing that income. This is not a reason to avoid DRIPs. The long-term compounding benefit far outweighs the tax inconvenience, but it is something to track from the beginning so you're not surprised at tax time. One smart solution, which I cover in detail in the $50 Dividend Investor, is to hold your DRIP investments inside a Roth IRA or traditional IRA where dividends can compound without creating an annual tax event. That combination, DRIP inside a tax-advantaged account, is genuinely one of the most powerful setups available to a beginner investor. So here's where we land. A DRIP is not complicated. It is not risky. It does not require you to watch the market or make active decisions. It is a simple instruction you give your investments. Take my dividends and buy me more shares. That instruction, repeated over years and decades, is what turns $50 a month into a portfolio that generates income on its own. Wealth building that requires no active management. Passive income that is genuinely passive. Everything I have shared today is built on the foundation laid out in the $50 Dividend Investor by Talon, available now on Amazon. The link is always in the description below. Next week on the $50 Dividend Investor Podcast, we're talking about the very first stock a beginner dividend investor should know about, what to look for, what to avoid, and the simple 3-question checklist I use before buying anything. You don't want to miss it. Subscribe so it lands right in your feed the moment it drops. I'll see you there. Start small, think long, build forever. And that's episode 2 of the $50 Dividend Investor Podcast. Remember this, the snowball is already waiting for you at the top of the hill. The moment you set up that first DRIP, it starts moving. And once it starts, your only job is to not stop it. Add your $50 every month, let the dividends reinvest, and get out of your own way. If this episode added value, hit subscribe and send it to someone who keeps saying they will start investing someday. Next week, we're getting into one of the most practical episodes of this series, the very first stock every beginner dividend investor should know about, including the simple 3-question checklist I use before buying anything. I'll see you there. Start small, think long, build forever.
Welcome to the table where the green meets the gold. Green meets the gold. I'm KR Talon, and we're planting seeds today, not just checking the ticker. Not just checking the ticker.